All right, today on Talk Tickers, we are diving into one of the most bizarre earnings reactions I've seen all quarter. We're talking about ICU Medical. The company posts this monster earnings beat, and the stock gets absolutely crushed. So we're going to figure out exactly what Wall Street saw that maybe the rest of us missed. Let's dig in. So first up, the headline number that got everyone excited. ICU Medical reported adjusted earnings per share of $2.10. Now, to put that in perspective, the consensus on the street was way down around $1.44. So they didn't just beat expectations, they completely blew them out of the water.
But, and this is the whole reason we're talking about this, look what happened to the stock. After a tiny little pop when the numbers first hit, the very next day, the stock just fell off a cliff. We're talking a drop of over 13%. So what gives? Why the brutal sell-off after such a great report? That's the puzzle we need to solve. Okay, so here's our game plan. We're going to look at that beat and the drop, then we'll peel back the layers of the quarter to see what's really going on. Then we'll zero in on the guidance and this tariff issue, which is key. After that, I'll give you our official rating for the stock, and we'll wrap up with a trade idea. So let's start by really framing this complete disconnect. On the one hand, you have this picture-perfect earnings beat, and on the other, you have a stock chart that looks like a horror movie. Now, here's where it gets really interesting. Yeah, the 66-cent beat gave it a small, temporary 2.4% bump after hours. But that next-day plunge of 13% happened on massive volume, over 1.1 million shares. That is nearly 3 times the normal daily volume. Folks, that's not just a few nervous investors. That screams institutional selling. The big money was running for the exits, and they were running fast. So to understand why the big funds were dumping the stock, we have to look past that shiny adjusted EPS number. We've got to pop the hood and get into the real guts of the quarterly report. The answer, as always, is buried in the details. And to be fair, there was some genuinely good news in here. Their consumables business, which is their biggest piece of the revenue pie, actually had a record quarter. We're talking over $273 million. That's a solid operational win, and it shows the core of their business is actually quite strong. But here's where the story starts to unravel. You have to understand the difference between the adjusted numbers that companies love to talk about and the official GAAP numbers. While adjusted EPS was that great $2.10, their actual reported revenue was down 8% compared to last year. And that big jump in gross margin? A lot of that wasn't from selling more stuff. It was heavily skewed by an accounting change related to their IV Solutions joint venture. So what's the takeaway here? A huge chunk of that fantastic margin growth wasn't really from the business getting better, it was basically financial engineering. And you can bet the smart money on Wall Street saw right through that. They looked past the accounting tricks and saw 2 red flags. Revenue was shrinking, and their vital care business looked soft. They were focused on the real health of the company, not the cosmetic facelift. But you know what? Even that wasn't the true killer. The real reason the stock got destroyed wasn't about the quality of the quarter they just reported. It was about what management said was coming down the pike. The market completely ignored the past and focused on one massive dark cloud on the horizon: tariffs. Management basically came out and put a number on it. They said their total tariff expense for the year is now probably going to be at the high end of their estimates, coming in at around $30 million. And the scary part? The problem is actually getting worse, not better. They specifically pointed out an extra $5 million hit just from new tariffs. So this isn't an old problem they're managing, it's a new headwind that's picking up speed. And just in case you thought this was some minor accounting issue, the CFO, Ryan Bonnell, said it himself on the call. This isn't some paper loss. He said, and I quote, "It's real cash out the door." And let me tell you, when a CFO uses language like that, Wall Street sits up and listens. So all of this led to the final nail in the coffin, a guidance update. Can you imagine? They just reported a blowout quarter, and in the same breath, they basically told investors that the rest of the year won't be as good. They lowered the top end of their forecasts for both EBITDA and EPS. That was the signal. For investors, it meant that Q2 was a fluke, and that these tariff costs are going to permanently damage the company's ability to make money. So, with all that said, where does that leave us for the next earnings call? We have to balance what management is saying about their solid operations against what the market is clearly screaming about this tariff problem. You've really got 2 completely different stories here. Management's story is, hey, look at us, we're executing. Consumables are killing it, our margins look better, we're paying down debt, and just wait for our big 2026 catalyst. But the market story is much simpler. We don't care. The tariffs are a cash-burning nightmare, another part of your business is weak, and we just don't believe these profits are sustainable. So after weighing everything, our rating for the next call is market perform. This is a classic case of a decent company that's executing pretty well internally, but they're fighting a huge external battle that they have very little control over. That tariff issue is going to act like a ceiling on the stock price, limiting any real upside until something changes.
Okay, so if we think the stock is basically stuck in neutral, how might you play it? Let's get into our outrageous but plausible trade idea.
The question is pretty simple. How do you trade a stock that's probably going to trade sideways for a while, but has a potentially huge catalyst way out in the future?
All right, here's the pitch. The core idea is that the market is rightly focused on the short-term tariff pain, but it's completely sleeping on that big 2026 pump cycle catalyst. So one way to structure a trade is to buy long-dated call options, maybe ones that expire out in 2026 to capture that long-term upside. Then, to help pay for those options, you could sell shorter-dated calls against them, basically collecting a little income while the stock grinds sideways. The catalyst that unlocks it all? Any good news on tariffs or management giving more concrete details about that 2026 ramp-up.
Now, of course, this is not financial advice, but it's a perfect case study. The next time you see a stock plummet on what looks like great news, remember to look past the headline. The real story is always in the details. Thanks for watching.